I'm always looking for ways to show my cat how much I love her. And with Fancy Feast gems, I can pamper her whenever I want with a savory gravy on top of a gourmet mousse pâté. The pyramid shape makes serving simple, so all I have to do is peel and plate to make mealtime feel extra fancy. And with 2 entrees in every pack, it's easy to turn every day into the extraordinary. Fancy Feast gems.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.
Atheists, agnostics, long-haired weirdos, short-haired weirdos, vandals, hooligans.
The government, hug the government, love the government, hug the government, love the government, hug the government.
Welcome to The Politics Guys, a place for bipartisan, rational, and civil debate on American politics and policy. I'm Northern Kentucky University political scientist Michael Baranowski. My guest today is Leah Downey, a junior research fellow at St. John's College, Cambridge, and the author of Our Money, Monetary Policy as if Democracy Matters, which we'll be discussing today. Leah Downey, welcome to the show.
Hi, thanks for having me.
So I wanted to start at maybe sort of a higher level, just to make sure listeners and everyone's on the same page, because sometimes folks aren't necessarily all that familiar with monetary or even fiscal policy for that matter. So can you just start by giving us a sense of the differences between monetary and fiscal policy, including who conducts which?
Yeah, great question. So I'd say the sort of party line on this, the typical view is that we usually think of fiscal policy as the sort of political branch of macroeconomic policy. So it's tax and spend, right? It's usually done by the legislature, although there's been some more executive involvement recently. And it's what you think of coming through the budget, whereas monetary policy is usually thought of as the regulation of the money supply, right? So of the creation of money, using regulation and interest rates and the sort of regulation of private money creation. And that tends to be conducted by an independent central bank in the US, that's the Federal Reserve, and thought of as broadly not political. But it's not as always as easy to divide things up this way between fiscal and monetary policy, as I've just described it. I mean, a common way of describing this division, right, is that monetary policy is roughly about sort of ensuring that the economic pie is as large as it can be, sort of keeping our output at potential, whereas fiscal policy is about sort of dividing up the pie, right, and distribution. But of course, in reality, monetary policy has huge distributional consequences. And perhaps even more importantly, how you divide up that pie, right, using tax and spend can have really serious implications for how big the pie will be in the future. So that's the kind of general picture, but also with some caveats, because it never is as straightforward as that, is it?
No, never. But, when I used to teach economic policy, when we talked about money creation, I found that a lot of the students, it was hard for them to wrap their heads around the whole concept. And in the U.S. system, of course, the U.S. Central Bank, the Federal Reserve, creates money. And again, that concept, what do you mean creates money? Well, maybe you can help folks understand what that exactly means in real world terms.
Yeah, definitely. So you're, of course, right. So the Fed does create money. It creates money when it engages in what we call balance sheet policy, right? So the classic example of this that a lot of people will have heard of is QE, or quantitative easing, which is known in the sort of more technical sense as an LSAT, right? So a large scale asset purchase, which is exactly what it says it is, right? So the Fed, when it engaged in QE, did a lot of large scale purchasing of assets. And when it bought those assets from the private sector, in return, it gave the private sector cash, right? And to do that, it makes money. It just creates that cash out of nowhere. So it's as if you had control over your own online bank deposit, right? And you could just go in and using your keyboard, top it up with a few thousand or million when you felt the need to do that.
Yeah, and we're going to get into some of the potential issues with that here in a few minutes. But Staying on the Fed, there are essentially three parts of the Fed's legal mandate, and those are price stability, full employment, and to moderate long-term interest rates. And I think a lot of folks might not really understand what that, again, means in like real person terms. For instance, price stability doesn't mean prices never change, and full employment doesn't mean zero unemployment. So what exactly, when the Fed is looking at these things in this tripartite mandate, are there certain sort of targets or target ranges that they shoot for here?
Yeah. And I just want to say one last thing on that last question, which is that it's important to say, too, that the Fed, of course, creates money, but the sort of other major piece of its monetary policy job is regulating private money creation, right? So, of course, private banks are creating money all the time as well. When they offer a loan or a mortgage, they're creating that money out of nowhere, but they're doing that in a regulatory context, right? So they're doing that according to the regulations that the Fed creates and also the incentives that the Fed gives those private banks using interest rate policy. So the Fed can make it more desirable, less desirable to create more money by the private bank. So it's both creating money itself and monitoring and regulating that private money creation. But as you say, it does that in service of, at least legally, these three mandates that come in that the legislature gave the Fed in the Federal Reserve Act and has updated since. And as you mentioned, that's price stability, full employment, and moderate long-term interest rates. Generally, what those things mean in practice has changed over time and could change again, right? Because those are fairly sort of generic phrases. And interpretation has largely been left to the Fed itself. Since 2012, the Fed has pretty much explicitly articulated it as a 2% inflation target and what they call maximum sustainable employment. Now, what is maximally sustainable employment? As you say, it's not considered to be zero unemployment, right? It's generally understood as a level of unemployment that the economy would tend towards if it had persistent 2% inflation. Right. So what that means, in essence, is that the Fed has interpreted its sort of three-part mandate as really a single mandate for price stability.
Yeah. And I wanted to ask you about that because in the book, one of the arguments you make is that there was that one part of that mandate that really seems to be clearly more important than the others. And I was hoping you could explain how that ended up happening.
Yeah, it's a really great question. I mean, in other countries around the world, right, central banks only have price stability as their mandate, or oftentimes what they'll have is they'll have price stability as their primary mandate, and then they'll say the legislation will say something like, subject to sustaining price stability, the central bank should support the government's, policies or things like that. But so the U.S. is somewhat unique in the language that we have. And, it has created a different approach to monetary policy to some extent. But really, as I argue in the book, price stability has become pretty clearly the top priority. And there are a couple of ways you could answer the question, sort of, how has that come to be? You could give a sort of historical story. There's a technical answer, I think, and there's a sort of theoretical answer. I mean, technically, monetary policy transmission, so the tools that monetary policy makers have to manage the economy lend themselves more to inflation management than they do to employment management, right? And that's not an accident, right? So the Fed was set up really as primarily a private entity with public powers, and it was designed to support the effectiveness and efficiency of the private financial sector, and sort of after a major financial crash in 1907. And it's developed to do that, right, naturally. So it's been more concerned with inflation and financial crashes and less with employment, and the tools that it's developed, to lend to banks and to manage interest rates more easily fit that aim. I think the other really important thing to say is the theoretical basis for all of this. So as I, sort of mentioned, is that economic theory tends to suggest that the economy will naturally gravitate to maximum sustainable employment when price stability is secured. And that's on the back of what some refer to as the monetary policy neutrality thesis, or this idea that a lot of economists refer to as divine coincidence, which I think is quite an interesting and somewhat revealing term. But the idea is, of course, that the economy is going to tend to this optimal state if and only if inflation remains low and stable. And so you'll see that in discussions at the Fed, right, of, they're not super common, but every once in a while you'll get some discussions of sort of, well, should we be more concerned with maximum employment than we are? And some of the responses will be, well, that'll kind of sort itself out if we're able to maintain price stability.
Now, aside from that sort of fairly vague 3-part or 1-part, however you want to look at that mandate, the Fed has an awful lot of leeway. I mean, they get to decide whether or not they're going to raise or lower the federal funds rate and a bunch of other things. And so a lot of folks would say, well, wait a second, why do we have that? And the answer I always told folks, the students certainly, was, well, that's not a bug, that's a feature, because the idea is that you don't want to leave something as important as monetary policy to politicians, because they'll do things like, I don't know, not like there'd ever be a president who'd want the chair of the Fed to crank down interest rates so there's a lot of easy money flowing around and, it helps him look better. I mean, right out of the headlines. And so I think a lot of people would say, well, this is actually a really good thing. We don't want this directly in the hands of politicians. What do you think about that view?
Yeah. So in the literature, this is usually referred to as the electoral business cycle, right? So the idea that if politicians were in charge, they would just juice the economy right before the election. And in the short run, that might seem like a good idea. But of course, in the long run, economists, according to these theories I've just been outlining, would suggest that wouldn't actually have good impact on the economy. It would only lead to dangerous inflation. In the technical terminology, this is referred to as the time and consistency of monetary policy, right? So what looks good in the short run is actually bad in the long run. And so, the solution to this problem, quote unquote, is central bank independence, right? And it's the idea that we should sort of pre-commit to what we know to be good monetary policy. I find a lot to take issue with this.
I know you do.
The first thing to say is just what is good monetary policy, I think, is far from clear or far from proven. But to sort of set that aside for now, just to look at the sort of technical argument here, right? So, it's surely true that politicians are looking for popular policies, right? That's kind of the whole point of democracy, is to do what they think will be popular. And it may also be true, right, that as a result of that impetus, that very healthy impetus, they end up seeking some sort of short-termist or feeding some short-termist kind of tendencies of the electorate. That's possible. But I think it's definitely not true that the long term doesn't matter at all, right? So if we look at any other form of policy, right, tax policy, immigration policy, military, environmental policy, in none of those does it look as if the electorate and politicians, as a consequence, only care about the immediate short term. They factor in, right, longer term considerations when they decide what they think the best approach is. And furthermore, monetary policy, as you mentioned, and in the view of this sort of theory, is hugely important, right? So one of the premises of this kind of approach is to say, well, monetary policy is too important to be left to politicians. Well, I agree that it's hugely important, but it seems to me that the more important something is, the more important it is in a democratic context that it be kept ultimately in the hands of elected politicians. It's for the same reason that we want elected politicians to be in charge of the military, right? Or to hold the nuclear codes. What could be more important than that? So it just doesn't seem to me that this argument runs because it's premised on the idea that monetary policy is somehow importantly different to all these other areas of policy, either because it's more important or because it's more technical or because it has this unique sort of time and consistency structure. And none of those arguments, I think, are very compelling.
Now, some people would say, well, that's an argument for less democracy in those areas as well, but that's a whole other conversation. I'm not.
Yeah, Well, and people have made that argument, right? So in 1997, Alan Blinder, who himself was a central banker, wrote a very famous article in Foreign Affairs that said, government should be less political, right? Which I think sounds like an oxymoron, but that's, my view.
Yeah. I mean, now some people would say, though, but wait a second. It's not like, sure, the Fed can create money and it's self-funding and that's awesome. But in the end, Congress still has authority. Congress can alter its charter. They could even end the Fed, as the phrase goes, if they wanted to. Not only that, but the Fed chair, the Fed board of governors, they're appointed by the president, confirmed by the Senate. And okay, their terms are long. 14 years is a long term, and they can't be removed except for cause. But still, it seems to me that a lot of folks would look at that and say, well, yeah, there is political control, sufficient political control. And so really here, we've designed a sort of best of both worlds situation. I'm betting you don't necessarily buy that.
No, you would win that bet. So the 14-year term, first of all, just as a sort of aside, is a slight misnomer because it's people almost never sit to the full term, usually because instead they're leaving to go to some sort of lucrative position in private finance, right? So the independence issue there is not so much from political influence, but rather from the influence of the private industry. But you are, of course, completely correct that Congress could rehaul or eliminate the Fed tomorrow with a mere majority vote, right? Because the Fed is, of course, not enshrined in the Constitution. However, what I argue in the book is that the legislature's power over the central bank has, as a result of central bank independence and this particular arrangement that we have, has become pretty much merely formal, right? So the legislature's choice to remain silent on monetary policy for so long and embrace central bank independence has undermined its effective power to actively manage, to guide, to steer monetary policy. So while it retains this formal power over the Fed, its effective power has completely atrophied. So we're living in a world, I argue in the book, of central bank dominance in which it's the Fed that's calling the shots on monetary policy, not the legislature. And everybody knows it, really, right? So a good example of this is that the Eurodollar market or the international Fed swap lines, if international financial markets thought that these matters would be in fact dependent on Congress, or they thought that it was a real possibility that Congress would engage in actively managing these things, there's no way they would be as big as they are, right? Or as important as they are. So I just think it's pretty clear that we're in this case of central bank dominance and that the powers of the legislature have become pretty much formal.
Now, earlier you suggested it. Well, why would we have a different procedure for monetary policy and not these other things because they're not really that different? Well, some people would say they would. And one of those important differences is something called money neutrality. And I understand, if I understand the concept right, I might not. So when you answer, please let me know if I got it wrong. But it's this idea that at least in the long run, changes in the money supply aren't going to have a significant effect on economic output, employment, or GDP. And a bunch of economists, including Milton Friedman, beloved on the right, believe this. And when you were explaining this analogy, I love the analogy you used in the book. This tennis match ball person, maybe because I was a ball boy a million years ago, and so I appreciated it. But can you sort of explain that? Maybe even bring in that analogy, and then talk about why you don't really buy it.
Yeah, totally. I think this is super important, and it doesn't get talked about enough. So there are a couple of things to pull apart here. So you're absolutely right that the theory of monetary neutrality suggests essentially that money can have no long-term influence on the real actual economy, right? No physical dollars or cents actually go into producing goods. So all money is determining, right, is a sort of nominal price, not even a relative price. What determines how much we can actually produce and where and by whom, et cetera, is the real economy, right? Labor, capital, technology. So money here, as is sort of used, the term is used in the literature, right, as a mere veil, right? It's helping, all it can do is sort of grease the wheels of trade. It can't influence what we produce. So sometimes with my students, I will get to the tennis analogy, but here's another one I often use with my students here, which is that it's almost like this theory is like the monkey Shakespeare theory. So this is the idea that if a monkey has infinite time, it can type the whole works of Shakespeare, right? Well, in a way, that's kind of what this argument is. If an economy has infinite time with given levels of labor, capital, and technology, it's going to produce all possible output. But the long run in this theory is true only if we adopt this, well, is arguably true, only if we adopt this very particular conception of what the long run is, which is not related to time at all. It's related to equilibrium, right? So in economics, sometimes people will say, well, such and such will happen in the long run. And what the long run means is the whole system has readjusted to new conditions. Now, that could happen in 10 seconds. That could happen in 10 years. That could happen in 1,000 years. It could never happen because some other change has occurred in the meantime. So you never reach the original long run. And it seems to me that that last case is much more likely than the case that, money will actually not influence real production in, say, 5 years. Now, the analogy that I used in the book that you were talking about is this analogy to tennis, right? So monetary neutrality suggests, right, that monetary policy is also neutral in the long run. Because if money can't influence the economy, then if your policy lever is adjusting how much money is in the economy, that can't have any major effect either. So the best you can do as a monetary policymaker, as Friedman says, is avoid disturbance, right? So prevent problems from occurring. And so on this Friedman view, monetary policymakers, central bankers should be acting like ball boys at a tennis match, right? So they can't make the tennis any better given the players that are playing, but they can ensure that there's a smooth match going, right? So they give the players the ball when they need it. They don't throw a ball on the court when it's not needed, and cause problems. They just sort of ensure smooth play. But my critique, taken sort of in the context of this analogy, is that that's also not true, especially if we take the tennis match to be going on sort of indefinitely, right? So if you withhold the ball and the players don't have a ball at all, you prevent practice, you prevent development, right? You influence the style of play of the player. If you throw balls all over the court, and you flood it with balls, then of course you could trip someone, you could injure them, they can't play for a while, they might be harmed indefinitely, and so on and so forth. So the argument is that actually, ball boys have much more influence than perhaps they use on a regular basis.
Yeah, like I said, I really appreciate you bringing that in because I wanted to share that with folks. So I guess in the end, you're saying that this is a thing that's sort of theoretically true, but practically doesn't matter because, of course, in the long run, we're all dead.
Yeah, in a sense, it's like it's not even so much in the long run we're all dead. It's that the long run, as discussed by economists, never comes to being most of the time, right? It doesn't actually exist, right? Because when you talk about reaching the long run, one of the key assumptions is that policy doesn't change, right? So that's crazy.
Gatorade is the #1 proven electrolyte blend designed to hydrate better than water. So you can lose more sweat and raise your game. Gatorade, is it in you?
This episode is sponsored by Friskies, who would like to tell your cats hi. Now, if that didn't get your cat's attention, there is one thing that always does the trick. Just pour some Friskies crunchy food in the bowl and you'll hear those paws come running. Works every time. With so many Friskies choices, you can always bring your cats running from their secret napping spots. There's always more to explore. See for yourself at friskies.com or visit your local store.
So one of the concepts you bring in the book, one I'm betting that almost no listener has heard, now maybe some have, I wasn't that familiar with it, something called IOER. It comes up a lot in your book. It's pretty important. So maybe you can explain what that stands for and why it's actually a pretty big deal.
IOER stands for Interest on Excess Reserves. Since writing the book, it's now changed to just IOR, right? So interest on reserves. But most people, even those that are really familiar with monetary policy, tend to think that central banks conduct monetary policy, influence interest rates, using what are known as open market operations, right? Or OMOs, where they sort of buy and sell assets to influence the interest rate. But that hasn't been true in the US since 2008. So Congress in 2006 passed a bill that enabled the Fed to pay interest on reserves. Now, reserves are the currency that the Fed creates and holds in its account at the Fed, right? So they never leave the Fed. They're pushed around between the accounts that private banks hold at the Fed. So they're an ultimate form of settlement, right, of US currency. So, if I owe you money and I pay you in bank transfer, then my bank will owe your bank money, and they'll ultimately settle that using reserves at the Fed. So prior to 2008, private banks didn't like holding reserves at the Fed because they just had to hold money there and they couldn't earn anything on it, right? They weren't making money. So they were arguing and lobbying Congress that saying it was essentially a double penalty, right? So, they were required to hold these reserves because at the time the Fed had reserve requirements, requiring banks to hold a certain amount of reserves, and they couldn't earn money off of them. Now, I don't exactly see the logic there because we also force car companies to install seatbelts and we don't pay them to do that. But that's sort of beside the point because Congress did it, right? They changed the law in 2006, allowing the Fed to pay interest on reserves. Now, that law wasn't meant to come into power until 2011. But in 2008, when the great financial crisis hit, the Fed asked Congress to bring it forward, and Congress did. And the reason was that the central bank wanted to make huge purchases, right? So it wanted to engage in QE, or the LSAPs we were talking about earlier, these large scale asset purchases, in order to inject money into the economy. But it wanted to do that without throwing off interest rates by creating too many reserves in the system, because at the time it was managing interest rates by managing the level of reserves in the system, and therefore sort of how much banks would pay each other to lend money. So essentially what it did, and this is how it describes it itself, was the Fed used these payments of interest on reserves to, quote, sterilize their asset purchases, right? So what that meant was it detached its interest rate policy from the size of the Fed balance sheet. Because by paying interest on reserves to these private banks, it was able to manage the inflation level to the extent that it can. And then totally separate to that, it could buy and sell assets and change the size of the Fed's balance sheet. So as a result of this, right, what we have today is a central bank that conducts monetary policy in the sense of managing interest rates and other sort of money creation incentives through regulation and paying interest on reserves. And that's completely detached from the size of its balance sheet. So it can buy and sell assets, has this huge power to create money and do that. And that's not tied to its price stability mandate. It's also very notable that because the central bank engages in monetary policy by paying interest on reserves, when it does need interest rates to go up, right, if it's trying to fight inflation, for instance, and we're in sort of tough times in the economy and it's intentionally trying to slow down the economy, it does that by paying billions in interest payments to private banks, which is somewhat odd and counterintuitive. Yeah.
And so this is a big deal because we're talking about, well, what kind of money are we talking about here? I mean, why is this so underappreciated, or why should it be more appreciated by folks who care about democracy and monetary policy?
Yeah. I mean, to give you a sense of the size, I mean, in 2023, the Fed paid $116 billion, I think, in interest to banks, somewhere around there. But I think, honestly, I mean, that's huge.
Yeah.
but honestly, in the more important impact, in my view, is that it separates, as I was saying before, separates its power to create as much money as it wants and buy and sell assets from its management of price stability and inflation. Because for two reasons. One is essentially now we have a Federal Reserve with enormous money creation powers that aren't guided by its mandate. And that's kind of a problem. But second, we have this huge power of the balance sheet that could be utilized for other things that isn't being, because it's thought of as part of the central bank and separate to Congress. And so it's a very strange situation, in my view, that is sort of depletes state capacity on the one hand and sort of empowers the Fed on the other.
And one of the things you write in the book that I thought was really interesting is that central bank dominance, you say that it's democratically legitimate, but harmful to democracy over time. And I was really hoping you could explain that for folks.
Yeah, definitely. So the reason I put it that way is because, in my view, it's legitimate because it's completely within the proper purview of the Congress to decide to delegate monetary policy to an independent central bank should it choose to do that. So I think that, the legislature's choice to create the Fed as it did and in the way it did was democratically legitimate. However, I think nevertheless, it's harmful over time to the democracy because, as I mentioned earlier, in deciding to remain silent and not engage in monetary policy for this extended period of time and essentially cede that power to the Fed, the legislature has sort of undermined its own effective power to engage, right? So to revisit that choice, to change conditions, to actively manage and steer monetary policy. And it's as a result of not, using it, its effective power has waned over time. Its familiarity with what it could be doing and is choosing not to, essentially.
Let's say I agree with you on literally everything that you've said to this point. It's always a nice way to start, right? But I could still say some people saying, well, so what though? Even though it's maybe not as democratic as we'd like it to be, the proof is in the pudding. When you take a look at, say, U.S. GDP growth to GDP growth in the other OECD countries over the last couple of decades, we're doing pretty well. We're above the OECD average. And we do better than basically every democracy that kind of is I'll call it a near peer, the UK, Japan, France, Germany. And so some people say, you know what? It's not broken. Let's not fix it. Let's leave it like it is. It seems to be working out just fine. What do you think about that sort of position?
I think that position is applying the it's not broken view to the wrong thing, right? So the thing is that the argument that I'm making is not just that sort of the current monetary policy arrangement is itself undemocratic. It's that it undermines democracy more broadly over time, right? So put differently, right? You can't just have a small pocket of undemocratic monetary policy that's disconnected from the rest of the system. And that is for a few reasons. I mean, first, because monetary policy is absolutely foundational as a power of the state, right? So we tend to think in political science that the foundational power of the state is a monopoly on the legitimate use of violence. But if you keep reading, Weber, you also find out that he thinks it's the power to create money. And I think that's right. I think those two things are both key powers that make a state, essentially. So if one of those is undemocratic, then you're in trouble. And, second, and perhaps even more relevant, is that monetary policy is a key capacity of the state to actually do things, right? To shape the world that we live in. And if we give up the power to do that, if we give that power away, take it away from elected officials, then elected officials' capacity to actually impact people's lives, right? To change their world, and thus for people to feel that they are in fact guiding the state, right? That government is by the people, that's going to melt away, right? So when people start feeling that their vote doesn't matter because their elected officials can't or won't do what they want them to, then you start to see the chain of political delegation breaking down and belief in democracy and democracy itself in trouble. And so it's a broader, while I focus on monetary policy, which is, of course, foundational to the economy, part of the argument of the book is that it's foundational to democracy, right? It's not just, you can't pull those things apart.
And if you have democracy for the things that don't matter as much, but technocratic rule for the things that are super important, you don't actually have a real democracy in the end.
Exactly.
Now, after you, in the book, go into what you see as all of these significant problems with the Fed, then you take a look at, well, maybe some ways to mitigate these problems. And one of the concepts that comes up a number of times is something you call iterative governance. Can you explain what that is and why you see it as maybe a way forward?
Yeah, totally. So the idea here is for the legislature to sustain its effective power over monetary policy by knowing and regularly showing its dominance over the central bank, right? So the idea is for Congress to engage in more active management of monetary policy. That doesn't necessarily mean it has to do things differently, but it means it has to take responsibility for the way that we are doing things and face the choice and actively make the choice and publicly make the choice of doing things the way that we're doing them. So The idea is that that would be better for the democracy because you're going to sustain the power of the legislature over the central bank. You're also going to support state capacity, I think, because you're going to be reminding legislators of the possibilities of how things could be done differently. And in the book, I offer a couple of ways of doing this, right? So in particular, I discuss an avenue for structural guidance and an avenue for operational guidance. And essentially, there are just two ways in which the legislature could be engaging in this form of iterative governance.
And I wanted to ask you about that because you talk about something you call preferred asset taxonomy or PAT. And so could you, I guess, maybe I'm a little bit ahead of myself here. This is in the context of credit guidance, and I think a lot of folks might not understand what that term is. So maybe you can just walk us through what credit guidance is and how it works, and then how a system of this preferred asset taxonomy might work in practice.
Yeah, totally. So credit guidance is essentially the idea that we would engage in steering credit. So you would decide sort of where and for what type of projects and for who would it be easier or more difficult to access funding, right? And so currently in the US, primarily it's the private financial system that determines this, right? So if you want a loan, you go to a banker and the banker determines, who is most credit worthy, right? That's the terminology, and determines sort of who gets loans and on what terms. So our system of credit guidance currently is largely market driven, right? There are, of course, some major exceptions to that. There are, of course, regulations from the the federal government. And then there's also federal credit programs and some public banks and things out there that supplement that. But what my proposal is that you would have Congress more actively engaged in deciding on how we should be engaging in credit guidance, right? So that, again, as I said before, with discussing iterative governance, the PAT that I describe is a way in which the legislature could engage more actively in saying, we want more credit going to the central part of the country. We want less credit going to people who earn over X amount. We want more credit going to this sector or less to that sector. Or it could say none of those things, but it would be required to vote annually, essentially like a budget, but for credit, where it would have to declare that we want sort of more of this, less of this, or keep it the same. And so it would require a degree of public engagement with that question that we don't have.
The minute I read that section of the book, I thought I had a vision in my head. And the vision was of the Trump administration and MAGA members of Congress passing some sort of guidance legislation that would require the Fed to say, not extend credit or extend credit at higher interest rates to institutions that have, say, DEI programs, or maybe to give preferred treatment to fossil fuels over renewables or something like that. It kind of freaked me out a little bit. And so maybe you can address that.
Yeah, totally. I mean, one of the major criticisms, pushbacks that I get on the book regularly is like, do you actually want to give more power to people that are in charge of Congress in the United States? Are you sure you want to do that? And I think the answer just has to be that, insofar as one considers the US Congress a democratic body, and there are, of course, lots of questions there that political scientists have discussed at length, and some of them I think are really compelling issues. But assuming we take Congress to be a legitimate democratic body, then what I'm offering here would make credit policy more democratic. Now, would it make it more in line with my personal political views or yours? I mean, I don't know yours, but someone else's? Not necessarily, right? But that's democracy for you, right? I mean, that's the way it works. So it could be scary, especially to those people who feel like we're doing things pretty well right now. But that doesn't make it any less democratic. In fact, it might make it more democratic.
Democracy can be famously messy, and markets tend to hate messy. And so the other thing I thought of, aside from that, is that I could just see some extremists on either end really holding this up in a closely divided Congress, and the market's just freaking out because all of a sudden the Fed doesn't have any credit guidance. And what's that going to do? I don't know, but it doesn't sound awesome to me.
Yeah, I mean, I think there's a few things to say about that. The first thing is that, Congress has a lot of bluster, but it does usually tend to pass major economic legislation when it has to. But furthermore, and more importantly, and I think more interestingly, in the book, I argue that some of the issues, I think that some of the current issues in the US Congress, in particular, some of its sort of dysfunctionality, can be argued as that they're a result of some of the delegation of power away from the legislature, right? So if the legislature doesn't actually have to make hard, important political decisions because it's delegated those to administrative agencies, and they can merely say, deliver us good policy, deliver us clean air, deliver us stable prices, or no inflation and max employment. But they don't have to work out the hard trade-offs and compromises in the specifics to actually achieve those goals. It really lends itself to bluster, and to political performance and not real politics. And so part of the hope would be that re-empowering Congress, again, assuming here a Congress that is in fact sort of democratically legitimate in some meaningful sense, would enable more real political engagement and less bluster and action, if you see what I mean.
That's a really interesting perspective. Absolutely. So at this point, it seems like members of Congress are just sort of like this nuts who call into the radio call-in sports shows, and they can just say whatever the hell they want, But if you're not the coach, it's a whole different story. Anyway,
Exactly. Yeah.
Another thing you call for is regular rechartering of the Fed. And I'll say that's unusual, but it's not like totally out there. I mean, the FAA, I believe the Export-Import Bank, they both have to be rechartered every 4 or 5 years, something like that. So what do you see as the benefit of doing this with the Fed? And would this be, I guess I'm wondering if you think this might end up just becoming sort of a rubber stamp thing, or do you see it as like a real legitimate opportunity for people to rethink what the Fed's doing and how it's doing it?
Yeah, great question. So, I mean, it's worth saying that actually the first two central banks in the US, actually including the Fed, so the first three originally had time-limited charters, right? So the Fed itself originally had a 20-year charter, and then in 1927, the Congress extended it indefinitely and explicitly as part of, it was a sort of sneaky move actually, because it was an amendment to an unrelated bill. And if you sort of look into it, some of the debates around those who supported it, the extension, it was intentionally to sort of lock in the version of the Fed that they liked the most, right? So not to enable revision and reassessment. So the idea here is that you have something like the annual credit guidance that we were talking about before that enables the legislature to reconsider how monetary policy operates, right? So the way I explain this to my students is, if you imagine we have a system of pipes that travels around a city, and you want to be able, as the sort of government of the city, you want to be able to revise in two ways the system of pipes. You want to be able to think about regularly how much water is going through the pipes, at what rate, if it's also, not just water, what's going through the pipes, et cetera. Are they clean? And that's a kind of operational revision. And that's what I'm thinking about the annual credit guidance doing, right? So we want to think about where credit's going, how we're using the existing system. The other way you want to be able to revise it is structurally, right? So are there neighborhoods that don't have enough pipes? Are there neighborhoods that have too many pipes? Do we actually need to change the structure of the system on a regular basis, not just how we're using it? And that's what the rechartering of the Fed would be designed to do, right? So create a moment in which the legislature is forced to consider the structures of the institution and if we should change them. I mean, currently, the Federal Reserve System is made up of 12 regional reserve banks, which are still privately owned by the private banks in their region. We pay dividends to the private banks in those regions. The private banks influence who sits on the board of the regional reserve banks. And it's not clear to me. I mean, when the Fed started, it was essentially a largely private institution with some public power. It's now quite clearly a public institution with public power, and I think it could be changed to reflect that. That's something I would hope that would come up in a rechartering of the Fed, for instance. I mean, I think the rubber stamp point is a good one. It's a worry, right? It could definitely become that, especially given, as you mentioned before, that markets might be nervous about this kind of thing. But I would hope it wouldn't, and I would assume it wouldn't, just because it's an opportunity for the legislators to engage in changing things. And there's a huge amount of discussion in the public. Every 10 years or so, there's some sort of discussion about how the Fed could do something differently, but it doesn't really come to much because there's no forced moment of consideration. And so that's kind of what the aim would be.
Got it. So the difference between, I guess, a situation we have now where Congress can do this, but it's not forced to, you wanted to make Congress actually have to do something or other. Got it. I think some people would say, well, aren't there less dramatic or less ambitious, some would call them even less radical solutions? Like, for instance, I've heard some people say, well, the big problem with the Fed is that they're not funded by Congress. They get to be essentially self-funding. Or someone like, say, Thomas Massie, he's introduced his audit the Fed legislation, I want to say like 4 or 5 times now, right? And even that, which is far less ambitious than what you're talking about, just 46 co-sponsors, all Republicans, no Senate legislation, just died in committee, which it does every single year. Not like Thomas Massie's the most popular guy in Congress. That's another story. But I mean, why do you think that Congress seems to be so uninterested in a reform that's far less dramatic than something you're talking about? It just seems like crickets, essentially, aside from Thomas Massie.
Yeah. No, well, yes and no. I mean, there are some sort of pet projects. There's Pat Toomey, for instance, got really up in arms when the Federal Reserve Bank of San Francisco did some research on the relationship between monetary policy and climate, or monetary policy and racial inequality, because he thought that was well outside the mandate. So, but the problem is, I mean, as you say, is it tends to be sort of pet project issues, right? And part of that, in my view, is because the Fed has become a really desirable scapegoat for Congress, right? So you can yell about it doing things you don't want it to do. You can blame it for not solving problems that you actually don't have a really good answer to. And it's an independent agency, so it's not technically your responsibility. So it is like you're blaming something else in a certain way. So it's desirable for that reason, which is, as you rightly point out, the main problem with my proposals, right, is you'd have to get a Congress that actually wanted power. And that's the problem with Congress, right? Now, it doesn't want to be in charge. It doesn't want to be able to change things. It doesn't want responsibility. And that is a real problem. Now, I do think, though, that one of the differences between something like the audit the Fed proposal, which tends to come from those who think the Fed is being sort of profligate and spending too much, and with the exception of some recent debates about renovations to the Fed buildings, which are costing a scary amount of money, and I think is kind of, legitimately bizarre. With that, if we set that to the aside, I don't think the problem with the Fed is that it's spending too much money. That doesn't seem to be the major issue to me. The major issue, as we've been talking about this hour, has been, who has responsibility over monetary policy, who has true power over it, effective capacity to change it. And I think you, because of the proposals that I lay out in the book, are explicitly nonpartisan. There is nothing about the types of policies that the legislature should implement, just who has the power and responsibility to guide them. And so if you were able to assemble a congressional coalition that essentially, it's sort of, perhaps it's too nostalgic and old school, but essentially politicians who thought, I will win the political argument and then I'll have the power to do something because I'll have power over monetary policy. They could have any politics at all. And so the idea is that you would hopefully find a coalition large enough in Congress that wants to establish a healthy democracy such that the legislature has the power to do these sorts of things, regardless of sort of who's there. Now, you may call that a bit naive, and it may be, but nevertheless, it is what would make it more democratic, I suppose. And that's the core argument of the book.
Yeah, well, I think it's a core argument. It's an optimistic argument that we can find people out there who are willing to do that and actually elect them to Congress. And so I think that's actually a pretty good place for us to stop on that sort of, I'll call it optimistic, not naive note. Let's go with that. Okay. So Leah Downey, it's been so great talking with you.
And you, thanks very much for having me.
Thanks for listening to this Politics Guys interview. If you want to get in touch with us for any reason, you can do that in a bunch of ways. There's email, mail@politicsguys.com, as well as Facebook or X. Links for those are in the show notes. There's also our Discord discussion forums for supporters, which I am on all the time, probably too much. No. But anyway, if you're not already a supporter, I hope you'll consider becoming one. When you become a supporter, you not only help us continue the work that we're doing, but you get ad-free versions of everything we release, as well as the full-length midweek episode, as opposed to just that 15 or so minute preview. And if you'd like to get that full-length midweek episode, but you're not in a position to financially support us right now, not a problem. Send me an email, mike@politicsguys.com, and I will get that set up for you. And whether you're a supporter or not, it really does help us out if you subscribe, rate, and review us on whatever podcast app you use, as well as sharing episodes on social media. And finally, a very special thanks to our executive producers, Wilma Moreno, Daniel Toe, Ryan Beasley, Don Oglesby, Derek Schmidt, Dakota Heath, Jason Chrysler, Dave Dean, Jeremy Larson, and Brian Matza.
This podcast is part of the Democracy Group,